Hey, Econ Kids, this is Mod 27, the Federal Reserve, and dealing with some monetary policy. So we addressed fiscal policy before, now we got monetary policy coming at you. What exactly is this monetary policy? So first of all, we learned last time that the Federal Reserve System is the central bank of the US, there's a board of governors, there's 12 Federal Reserve banks. Awesome. Now, what do they actually do? Well, when you look at the function of the Federal Reserve, it's basically the banker's bank, right? So when banks have issues or they're short on cash, they can go to the Federal Reserve banks and they can borrow some money. It is also the bank of the federal government. So the US Treasury has a checking account with the Federal Reserve. That is good to know, and we'll talk about that as we get into some like open market operations ideas. So their job is to supervise and regulate banking institutions, right? So the regional Federal Reserve banks examine and regulate commercial banks for their district, make sure the commercial banks are doing what they're supposed to be doing, holding enough money, etc. The Board of Governors can also say, it can supervise, right, and say, hey, like this is what you need to do to those banks, besides just the regional federal bank, but the Board of Governors can do that too. And then the whole point is maintain the stability of the financial system. Like we have to trust our money has value. We have to trust that our money is worth something. So the idea of that stability comes from the Fed. And the Fed then can also provide liquidity to financial institutions to make sure that, hey, my money is safe and you can get it out of the bank, etc. Probably the most important is monetary policy, which we'll talk about here in this section. So the main tools of the Fed, what can they do in terms of monetary policy? Well, there's the reserve requirement, the discount rate, and open market operations. We'll address all three of these, but the open market operations one is going to be the one that is used most often. So first of all, what is the reserve requirement? Well, banks have to keep at least 10% in the required reserve ratio over a course of a two-week period, or they face a penalty. Now, it doesn't always have to be 10%. Right now, because of the pandemic, etc., it's like 0%. But when you think about this idea of fractional reserve banking, what it means is when you deposit money into the bank, they only have to keep 10% of it. And then they can loan out the other 90% to you. Banks make money when they make loans. So they don't want to keep money in reserve if they don't have to, right? They want to be able to loan it out because the interest on the money loaned out is where they make their money. So if for some reason they fall short, your regular bank, the federal funds market can let the bank borrow from them to be able to cover it if they were short. So, for example, they loaned out 91% of the money and they were supposed to have that 10% in reserve, but they only have 9% of all the money in reserve. They can go to the Fed and say, hey, I need a loan for the 1% to make sure they're in balance of where they're supposed to be. I can change the Federal Reserve requirement if I'm the Fed. So if the Fed decides to reduce the reserve requirement, that means there's more money that banks can loan out. If banks can loan out more money, then there's more money in the system. It's easier to borrow. This one is not the most used policy, right? Instead, they're going to use other ones, maybe a little more effective, but they have used it. And like I said, recently they've used it to get more money into the system, especially when we know that multiplier exists. And if I can get people to borrow a little more, then those people who are borrowing are also going to, spend more. And then of course that multiplier happens and, we have a whole bunch of money in the system. The second monetary policy thing here is going to be the discount rate. So the discount rate is the rate of interest that the Fed will charge for loans. So when banks borrow money from the Fed, they're getting this discount rate. Like that's what they borrow from. So it's usually 1% above the federal funds rate, which is the rate you borrow from another bank. So they're actually paying a little bit more to borrow from the Fed. So banks don't like to do that really, because if they can get the money covered in a different way, they would much rather do it that way because it's cheaper. But the Fed can change this amount of the discount rate whenever they want. So if they say, hey, you can borrow at 4%, or you can borrow at 3%, or you can borrow at 5%, it's going to be more likely for banks to be able to borrow from the Fed if they can get a better rate. So this is sort of a secondary tool of monetary policy. Again, Banks don't like to necessarily borrow from the Fed if they can get the money cheaper from, let's say, borrowing from another bank, because if they borrow from another bank, they might be able to get 4%, whereas if they got the discount rate from the Fed, it might be 5%. And again, banks don't like being short anyway, unless, of course, they're loaning it out at a 9% interest rate. Then if I'm, only have to pay 5%, it's not as big a deal. But banks don't like to be under, if you will. The last one is open market operations. So if you go to like B down there, this is the most commonly used form of monetary policy. This is what can make more money into the system or not. So when you look at this one, what's going to happen is, here is you, right? And you go put your money in a bank. So your money is going to go into the bank, right? So the bank has your money in here, and they're able to then loan out, what do we say, 90% of it roughly is usually what happens. 10% in reserve requirement, 90% loaned out. Well, the bank has money in the bank, right? But they also have treasury bonds that the Fed will let the bank hold. Okay, so if the bank has money here and the Fed wants less money loaned out, so the bank wants to make it harder, or not the bank, the Fed wants to make it harder for you to go borrow money, right? So this is your friend, let's say, wants to borrow, is getting a loan, all right? So they're getting this 90% loan in here. Okay, so this is basically what happens. You put in your $100, they're going to loan out like 90 of it. Your friend gets a loan for $90, and then this is the process that happens. They go out and buy something, etc. But if the Fed says, "Hey, we don't like this much money being out in the system. We want less money to be in," then the bank has two things. So here's the bank again, right? The bank has cash, and then they have bonds that are here, okay? Like treasury bonds. Here is the Fed over here. We'll make the Fed look a little like fancier, if you will. Ooh. This is the Fed. So now, if the Fed wants to take money out of the bank, right? The Fed can give bonds to the bank at a decent rate of interest, right? And then when they give bonds to the bank, or they sell bonds to the bank, I should say, the bank is going to give the Fed cash. Okay? So what's going to happen here? My cash flow went down, my bond holdings went up. Okay? If that's what happens, then the bank has more bonds on hand. So they can't loan out a bond to somebody else. So the cash is like less. Therefore, you're going to end up having to pay a little higher interest rate on that cash to get it, because there's not as much cash in the system. So what effectively happened here was the Fed made the economy smaller by taking cash out and putting bonds in. So this is selling bonds, sell small. When they decide to sell bonds to banks, the economy is going to decrease in size because there's going to be less cash on hand to loan out. The Fed's going to hold cash and not so much the bonds, and therefore the interest rates will have to go up. It'll be harder for you to borrow. All right? So now, what if the reverse happens? Okay, so now the Fed here, let's say they decide we need this to get bigger, right? We need more money in our economy. Let's erase the Fed here for a second. Okay, we need more money in the economy. We're in like a recession. We need to make it easier for banks to borrow, for people to borrow from banks, I should say. So here's the Fed. So this time, the Fed wants the bank to have more cash. So remember, they have some bonds here. They're giving a pretty good interest rate on those bonds, so they're keeping those. But the Fed's like, you know what? We want you to have more cash. So the bank now is going to sell bonds to the Fed, or the Fed is going to buy back those bonds, right? And they're going to give the bank cash for those bonds. And now that cash, what's going to happen with the cash? Well, the cash means you as the bank can loan that out. So your cash flow went up because the bond went down. The Fed now has their T-bills, treasury bills, bonds, whatever whatever you want to call them here. Those are going back to the Fed. The Fed's going to hold those. They're going to give cash for them. So what happened? When the Fed decided to buy bonds, buy went big, right? You made the economy bigger because you bought up the bonds as the Fed. So when the Fed decides to sell bonds to banks, they have to take cash out of the system, which makes your economy smaller. So sell small, right? Sell small. And when they decide to buy the bonds, the bank now is flush with cash, and that buy is going to make the economy bigger. This whole idea is called open market operations, and this is what the Fed uses to be able to get people to borrow more, and then if they borrow more, they spend more. All right. There's a graphic here. Like there's a central bank up here. Here's the bank, and it's showing the same concept happen. You get when bonds are coming out of the system and the cash is going in, it's going to equal low interest rates, a high money supply. You're going to see people spend the money. If you get the other side where you want to control for inflation instead, now you're pushing bonds into the market, right? It ends up having high interest rates because there's low money supply and people are going to have to, pay a little more to borrow. So that's the whole idea of open market operations. We will watch a Jacob Clifford video on that too. It gives you kind of the same example that I just gave you there. We'll look at some of these T-charts where it shows like this open market operations where it says, oh, now you have these treasury bills. What does that mean for you? How much of that treasury bill do you want to hang on to? How much you can be able to loan out, etc. And we'll look at some of these T-charts in class. All right. With that being said, that's module 27. See you next time.